Hello, this is Bob Steele. In this lecture, we will continue on Chapter 13, moving on to dividends. So we have cash dividends. Regular cash dividends provide a return to investors and almost always affect the stock market value. So we're going to compare dividends in a corporation to the draws for a sole proprietor. So just like in the sole proprietor, when we had the accumulation of money into the capital account, oftentimes the owner could then decide to take the money out in the form of a draw, reducing the amount of capital owed to the owner. In a corporation, we have the retainment of earnings, retained earnings, being similar to the capital account, which is the accumulation of the retained earnings over time. And the decision that the corporation needs to make is, should we take that accumulation and invest it back into the company, or should we decide to give it to the owners, in this case the stockholders, in the form of a dividend? So once a dividend is paid out, usually that affects the market value. The market value isn't directly tied to the book value, but if the dividend pays out, then you would think the value of the company has gone down slightly because they have given that value to the owners. So the decision that needs to be made by the company is, when we retain or accumulate revenue, and therefore if we have a lot of cash, for example, should we invest that cash back into the company and try to grow the value of the company for the stockholders? Or should we distribute that cash, that value, in the form of dividends to the stockholders? So to pay a cash dividend, the corporation must have a sufficient balance in the retained earnings. So most states would say that you cannot distribute a dividend that's going to be larger than the amount in the retained earnings. That would end up with a negative retained earnings amount. The cash necessary to pay the dividend. Obviously, generally you would need the cash to pay the dividend. So accounting for cash dividends, 3 important dates. We have the date of declaration, the date of record, and the date of payment. So declaring a dividend for a corporation is a bit longer of a process, of course. We're going to declare the dividend at one point, and that's when we're going to record the dividend that we owe to the stockholders. The date of records is going to be the date that whoever owns the shares on that date will then be the ones who get paid the dividend. And of course, remember that stocks could be, for a publicly traded company, could be bought and sold all the time. And they're not being bought and sold from the company necessarily. Most of the trading is going on between investors. So the question is, who gets the dividend? If they're trading the stocks all the time, it's going to be whoever owned it as of the date of records. And then we have the date of payment, when of course the cash goes out at that time. So we have the accounting for cash dividends. On January 9th, a $1 per share cash dividend is declared on ZTech Incorporated's 5,000 shares outstanding. The dividend will be paid on February 1st to stockholders of record on January 22nd. The date of declaration, there's no entry. So when we declare the dividend, what's going to happen is, we haven't yet paid the cash, so cash is not affected. But we say that we owe the stockholders, as of this date, we've decided that the stockholders are going to be paid. We've made that commitment. Therefore, instead of crediting cash, we're going to credit the liability. We're going to credit the common stock payable. So the liabilities have a credit balance. We're going to make the bad thing go up by doing the same thing to it, which in this case would be another credit. The debit, then, we have to debit something for the debits and the credits to be equal, is going to be the retained earnings. So remember, this is similar to the issuance of a draw, where we would have credited cash and we debit the capital account eventually, debit the draws and eventually the capital account. In this case, of course, retained earnings represents the retainment of the income, and it represents part of the amount that is basically owed to the owner, in this case the owners being the stockholders. So retained earnings is part of the capital accounts. It's part of the stockholders' equity section. It has a credit balance. It represents the money that is owed to the owner in some ways, and therefore we need to make it go down because, of course, we paid that money out. And so it has a credit balance. We're going to do the opposite thing to it, which in this case would be a debit, which would reduce the retainment of earnings because it's no longer retained. We now paid it to the owners, being the stockholders. So accounting for cash dividends. Then on the second date, there's no entry, and then of course we pay the dividend. So on February 1st we pay the dividend, And when we pay it, is cash affected? Yeah, cash is going down. We paid cash. Cash is a debit balance. How do we make it go down? We do the opposite thing to it, which in this case would be a credit. We're going to credit cash, therefore we have to debit something. And we already reduced retained earnings. What we're going to debit now is the payable that we just put on the books. We just put the payable on the books when we declared the dividend. So now that needs to go down to zero because we paid it off. And payable is a liability. Liabilities have credit balances. We need to make it go down. We're going to do the opposite thing to it, therefore, which in this case would be a debit. So deficits and cash dividends. A deficit is created when a company incurs cumulative losses or pays dividends greater than the total profits earned in other years. So we have the accumulation of revenue would be the retainment of income, right? Retained earnings. And it's possible for us to have losses so that are greater than the retained earnings over the lifetime of the company. And that would result in a negative retained earnings, a retained earnings with a debit balance. It's also possible for a company to if they were to decide to distribute more in the form of dividends than they had in retained earnings, that could also result in a negative retained earnings. Most states will restrict the dividends that can be given out to the amount that is in retained earnings. That will generally protect the creditors, because if the company went bankrupt, then the first people that get paid is usually the creditors, the people that are owed, the company owes money to. So notice they're kind of backed up with the common stock here, because we break out the stockholders' equity into retained earnings and common stock. So even though the retained earnings is negative, the total stockholders' equity is positive because we're breaking out the investment versus the retained earnings. Some states will also say that if they do get a distribution that is beyond the amount that's in retained earnings, that's going to be a redemption of the stock, and there could be tax effects involved in that transaction. So stock dividends, a distribution of a corporation's own shares to its stockholders without receiving any payments. So we could have a stock dividend where basically we issue out the stock, so the individuals would be receiving stock as the form of the dividend rather than the cash, and can be used to keep the market price in the stock affordable. So sometimes we would say that why would you give a stock dividend? It could act in such a way that it would reduce basically the value or the market price of the stock, because there would be more stocks in the market, and it can provide evidence of management's confidence that the company is doing well. So we have a small stock dividend distribution of less than or equal to 25% of the previously outstanding shares. Large stock dividends greater than 25%. So if we're going to record a small stock dividend, Quest has 10,000 shares of $1 par value stock outstanding. On December 31st, Quest declared a 10% stock dividend when the stock was selling for $15 per share. The stock will be distributed to stockholders on January 20th. Let's prepare the December 31st entry. Capital retained earnings for the market value of the shares to be distributed. Okay, so we're gonna distribute the stock out there, and we're calculating out the 10,000 shares times the 10% times the 15 gives us the retained earnings of the 15. So that is like the market price that we're going to have there. So if there's 10,000 shares outstanding times 10%, that means there's going to be 1,000 that are going out, and the market price is 15. So the retained earnings, remember, is a credit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a debit. We're taking it out of retained earnings and we're putting it into the capital, because now we're counting it basically as the investment. So that, notice there's no effect on the total stockholders' equity. What we're doing is reducing the retained earnings and moving it up right up into the capital accounts. So the common stock dividend distributable is going to be that 1,000 shares times the $10 par. So remember, we're going to increase the amount of common stocks out there by the par value, and then the difference is the paid in capital in excess of par value, the value that went out over the par value, just as if we were to sell the stocks when we've issued it over the par value. So then we have a stock split, a distribution of additional shares of stock to stockholders according to their percent ownership. So that basically means, if we look at this example, we have the old shares outstanding, and there's $20 per share common stock and 100,000 shares. And then we're going to basically just issue the new stock now, which that means that if we just did a stock split, now it's worth $10 per share, but there's 200,000 shares out there. So what this means is there's no difference to the owners as to the value of the shares. It's just that now they have twice as many shares that have half as much of the par value. And you can think of that when they're calculating their market value too, or their cost for when they sold it. What they're going to do is they're going to say, now my shares are worth, I have twice as many shares that are worth half as much, or I can say the cost of my shares were half as much. So that's going to be the idea of the stock split. Stock split is not going to affect the holdings of the shares, meaning the percentage of the shares that an individual stockholder owns in comparison to other owners, and therefore the amount of weight that the individual has in terms of voting rights will remain the same. So that would be the stock split.